The truth is that most people don't have a money problem. What they have is a direction problem. You can have two families that are earning the same income and one feels completely lost and the other one has clarity and control. Well, the truth is that it's not that one family is smarter or luckier. The reality is that not a lot of people are taught about investing. So in this video, I'm going to go exactly over how investing actually works, how to avoid mistakes that can cost you thousands of dollars in the long run, but more specifically, how to build a strategy that gives you clarity and control. So if you've ever felt financially like you're just doing okay and you're not fully confident about where you're headed, then you need to stick with me in this video. Hi, this is Smart Money Moves with Rod Loyola. Happy to have you here. Thanks for investing the time. And I want to say to you, please don't forget to subscribe to the channel once you have a chance, because I'm hoping that I can pass on a lot of great information to you. So today we're going to be talking about one of the most important financial skills which anybody can develop, and that is investing. And I want you to think of this as steering a ship, and you're already in the water, and the question is whether you're drifting or you are going in a particular direction. And so this session is not about complicated financial jargon. It's about understanding the fundamentals. So today we're going to be covering why investing matters to begin with, how different investments work, how to manage risk, and how to build a portfolio. And of course, as I stated in the beginning, how to avoid some common mistakes. So first thing we're going to talk about is the key mindset for investing. Now, I want you to get out of your head that investing is like gambling, because a lot of people have this narrative running through their mind. And so gambling is like spinning a wheel and hoping that it lands your way, like in roulette. But investing is much more like planting a tree and allowing it to grow over time. So investing is a long-term strategy that is very structured. So let's talk about the importance of investing. So what happens if we only save money but never invest it? Now, a lot of people, some people may know the answer to this, but the reality is that some people don't know the difference between saving and investing. And so we're going to hit this basic fundamental definition so that people can know the difference. So saving protects money. So it's like putting your money into a locked safe. It stays secure, but guess what? It doesn't grow. Investing actually grows money. So it's like putting that money to work as employees that go out and earn more money for you. Now, the reason why it's important to invest and not just save is because of inflation. Now, you know that prices increase every year. And so the inflation rate commonly is around 2.5% every year. So that means the box of cereal that you bought last year is actually costing you a little more this year, even though the price could be exactly the same. And it has to do with purchasing power. So the purchasing power of your money. So when you save money in the bank, you think, okay, well, I have it saved. But the reality is that because of inflation, the money is actually losing purchasing power. So this is why it's so important not just to save money, but to actually invest it. Quick question. If you and your partner stopped working today, would you actually know how financially secure your family is? Well, most dual income families are earning well, saving something, investing a little, but still aren't completely sure where they stand. That's exactly why I created the Financial Blindspot Scorecard, a simple 3-minute assessment that helps you identify hidden gaps in your financial plan. It gives you clarity on your financial standing, highlights potential blind spots, and helps bring structure and peace of mind to your financial future. If this sounds great to you, get the assessment done. The link is in the show notes below. Again, it takes 3 minutes to get it done. If you're watching this on your TV, scan the QR code. As I said before, click on the link in the description below. And I want you to think about inflation as like a slow tire leak. that you may notice, you may not notice it like on the first day or the second day, but as time goes on, you see that the tire is losing air and that you have to figure out how to get it fixed. So think of it, as I said, cash sitting idly loses purchasing power. So I want to give you an example. If you have $10,000 today, of course, those same $10,000, even though you have it saved there, it will buy you less in 10 to 20 years from now. So how do we get out of this? How do we make sure that that doesn't happen to us, that we're not losing purchasing power? Well, number one, it's the power of compounding. And so money earns returns. So think of it as money earns returns, and then those same returns that you're making end up earning even more returns. So the money grows and grows and grows and grows and grows. And I'm going to get into some examples and show you one of my financial calculators a little bit later as we get into today's video, so that you can actually see the power of compounding. So, but for now, just think of it as a snowball that's rolling down a hill. So it can start really small, but by the time it gets to the bottom of the hill, it's gained significant size. And also, not only that, as it speeds up, it's speeding up as it gets even further and bigger and bigger and bigger. So think of that as your investing account. So growth accelerates over time. And I'm going to show you some very specific examples of just that. So one of the things that I like to tell a lot of my clients is that small amounts invested consistently can actually grow significantly. So investing allows people to, number one, build wealth, reach financial independence, prepare for retirement, or achieve any short, medium, long-term goals that you may have. So instead of pushing uphill forever, you begin to let the momentum work in your favor. Let's get into types of investments. So there are specific main asset classes. So number one is stocks. I'm sure that many of you have heard of the word stocks, but you may not be 100% on what it actually is. Like, of course, there are some seasoned investors out there that may be watching this video and they'll be like, of course I know what stocks are. But I'm going to assume that you've never actually looked into this. These are words that you hear, but you may not know exactly. So I'm doing this for the person that has very little knowledge when it comes to investing. Keep that in mind. So stocks are essentially ownership in a company. So like owning a small piece of business, your share grows as the business grows. So investors participate in the company growth, and of course, every company has potential for higher returns, but you also have to keep in mind that it's also higher volatility. So prices can move like waves. I'm sure that many of you have seen the stock market graphs, and so it actually goes up and down, up and down. So sometimes it's calm, and sometimes it can be really rough. So for example, you may invest in very large companies, technology firms, or even global corporations. So those are examples of stocks. Okay. Now, one of the other forms of investing is in bonds. So this is where governments or corporations actually, you're lending money to governments and corporations. So you become the bank and they pay you interest for borrowing your money. So if you invest this way, investors receive interest payments. And generally these are lower risk than stocks, but also they're usually lower returns. Many of you may have heard of mutual funds. So this is where you actually pool money with many different investors. So it's like joining a team where everyone contributes and invests together. Now, this mutual fund is then managed by professional fund managers. And of course, and they're investing across multiple stocks or securities. So it could be, for example, a mutual fund can have a certain portion in bonds, or it could have a certain amount in stocks, right? So the benefit of a mutual fund is the fact that there's built-in diversification. So I know I'm making analogies to gambling. So for example, instead of betting on one horse, you are actually owning part of the entire race. So then that way, it doesn't matter really which horse wins, you're still going to get a little bit of return. Now, what have become really popular over the last 10 or so years are exchange trade funds. You'll hear people talking about ETFs, and ETF stands for exchange trade fund. So these are similar to mutual funds, but they actually trade on the stock exchange as if they were stocks. So there's lower management fees with ETFs. And so, for example, you could have an index ETF that's tracking the market. So let's say, like the S&P 500. And so you'll have an exchange trade fund that has many stocks that is basically mirroring the S&P 500. So this is like buying the entire market in one simple basket. So other investments that I want to just mention very briefly are, of course, real estate, and then commodities, and then, of course, you have private investments. So most investors build portfolios using stocks and funds. So not one single winner, but a strong team all working together. And you want to make sure that you're diversifying as much as you possibly can. So let's start talking a little bit now about risks and returns. So this is actually a core principle in investing. So the higher potential returns usually come with higher risk. So think of this as the bigger the potential reward, the rougher the possible ride on the stock market or the ups and downs of the market. So it's very important that we define risk. So risk means that there's price volatility, that there could be temporary losses, and of course, there's uncertainty about outcomes. So like sailing on the ocean, conditions can change, and you must be prepared for the waves. Now, I want to give you some examples here so that you can compare. So you have low risk. So these are, for example, a savings account, very low risk. You have government bonds, which also are it's very low risk because the government is making a commitment to pay you back a certain amount by a certain amount of time. Now, moving on to medium risk, this is where you have more diversified funds. And so think of this as small waves, and there is movement, but the movement is manageable. And then you have high risk. So this is very much like individual stocks, speculative investments, and these are large waves, and there's more potential in earning or having a return, but also there's more volatility. Now, when we talk about risks and returns, the other factor that we need to take into consideration when we're going to invest is what we call the time horizon. And this matters a lot because if you have a long time of investing, let's say, you're 22 years old and you want to start saving for your retirement, and you start putting money into your registered retirement savings plan, you can afford to have higher risk because your time horizon is a lot longer. So you can have more. There's more ability for you to tolerate the volatility that I was talking about. So think of this as a super long voyage, and which allows you to ride out any potential storms, okay? And then of course, there's a shorter time horizon. So for this, you need more stability. So for example, if you're getting close to retirement, you do not want to have holdings that are going to be super volatile. You want to be much more calm. So let's say that same 22-year-old has been investing her entire life, but now they're getting closer to retirement. And so before they had their investments in that were a lot more risky. Now, as they get closer to retirement, they want to move money in their portfolio or their investments in a portfolio that's a lot more risky to something that's much more moderate or even low risk, so that they can make sure that they're not going to be subject to those, waves that are much more introduce more volatility, right? So managing risk, how do we do this? So there's three main tools that will help you to manage the risk. And of course, the very first one is diversification. I'm sure many of you have heard this. You've heard, oh, you need to diversify. You need to diversify. So what does this actually mean? Well, the analogy that I can give you and that you may have heard is just not putting all of your eggs in one basket. So you want to make sure that you don't have, like, for example, if you're getting close to retirement, you do not want to be in like one or two stocks or even three stocks. No, you want to diversify. You want to have some money that's invested very conservatively, others more moderately, and then very low amount of your portfolio should be in high risk investments. Now, the other main tool is long-term investing. So like I was saying before, when you have a longer time horizon, this gives you the ability to smooth out the waves, if we'll continue with the same metaphor, right? Now, the other one, which not a lot of people think about or even talk about, is emotional discipline. And this is staying steady at the wheel, even when the waters get rough. And so a lot of people, when they are presented with the volatility in the market, for example, the market will begin to come down. And so what they do is they think to themselves, oh, I have to cut my losses. I'm sure you've heard a lot of people saying this, oh, you have to cut your losses, because they assume that this is going to go the investment that they've made is going to go further and further and further and further down. And this is true. This happens. But when you are when you are investing for the long term, my recommendation to you is just stay locked in. And then when it does hit a low, I would even suggest even investing more in that same stock. So then, because you're buying at a lower price, and eventually the market price is going to start going up and up. Now, of course, you have to be really careful about this, and you should always consult with a financial advisor, is my particular recommendation, because you want to make sure that you know what you're doing in these circumstances. But what happens to a lot of people is that the market will begin to drop, they sell, right? And then they see it going back up, and then they buy back in. And so what happens is that, well, you've lost a certain amount of money while it was going back up. If you would have just stayed in, then you would have seen that growth again. But of course, that is the best time, like I said before, to just buy a little bit more and then wait for it to go back up again. Of course, it depends on the stock. You have to think about what the value of the company is that you're buying into. That gets a little bit more complicated, but that's for perhaps another video down the road. So let's talk now about building your investment portfolio. So as I've mentioned in other videos, is that when you meet with a financial advisor, or before, let's say you even think about bringing a financial advisor on board or working with one. Well, let me put it this way. A good financial advisor is always going to ask you about what your goals are first. Now, take this to the bank. If you're sitting down with someone and they jump immediately into, okay, you need to invest in X, Y, and Z, then you know that they're more interested in making a commission, because they're selling you product right away rather than asking you about what your short, medium, and long-term goals are. A good financial advisor is always going to ask you what your goals are first. So and you may remember from other videos that I've done before, is you have to ask yourself, why am I investing this money? So, and why do I say that? Because you have to know what the destination is in mind, because you're not just driving without direction. When you start identifying what your goals are, then you know exactly where you want to end up. And so you begin investing with a purpose, right? So I want to give you an example. Examples of what your goals could be are retirement, could be education, purchase of a home, or that you want to be financially independent. But it's important to identify those goals first. Like other goals can be, example, considering what your risk tolerance is, right? How much risk are you willing to take on? So I understand that some investors prefer stability, while others are willing to take on the market fluctuations. So some people prefer a very smooth ride, while others are comfortable with bumps for faster progress down the road. So let's talk about a little bit more about diversification. So the key principle here is don't put all your money into one investment, as I mentioned before. So when you're diversifying, you want to think about diversifying in different industries, so specific industrial sectors. You want to think about diversifying particular regions. So for example, Canadian market, US market, European markets, Asian markets. These are the most common, right? When you look at some of the big mutual fund companies. And then of course, you also want to diversify across asset classes. So I want to give you an example of a portfolio structure. So as I was mentioning before, when you're younger and you have a longer term or longer time horizon to invest, well, you can have some more bumps along the road. Like you're going to be invested for a very long time. Now, of course, this is for long-term investments. So let's say a young person who's investing for their retirement, they're putting money away on a monthly basis. They can afford to be in something that's a little bit more riskier. So their portfolio structure would be something along the lines of 80% equities and then 20% bonds. And I'm just simplifying this for the example's sake. Of course, you would look at what your goals are, what your time horizon is, what your risk tolerance is, and then you would build a portfolio according to those factors. But let's take into consideration who is a more conservative investor. Well, a more conservative investor could perhaps have 60% in equities and 40% in bonds. So what's the key takeaway here? A portfolio should match the goals and time horizon and the comfort that the individual has with risk. So it's like building a team where each player has a role. So now what we're going to do is we're going to get into investing strategies. So the long-term investing, the focus here is staying invested for many years, allowing the compounding to work. And then of course, the key lesson here is that time in the market is more powerful than timing the market. Now, I'm sure that you've heard people talking about, well, I invest in a stock at a certain amount, and then I buy, and then once it goes up a little bit, I sell. Now, of course, like if that's your thing and that's the way you want to make money, then all power to you, really. But reality is that I hear, and this is the thing, is that everyone's going to tell you their good stories of the times that they made. Oh, I made like $20,000. But they're not going to tell you the times when they lost money. The truth is that when you're trying to time the market, there's much more possibility of losing money than there is to making money. And so I've heard it from people even very close to me that they've made that mistake. And yeah, sometimes they win, sometimes they lose, But the reality is that more often they lose rather than win. And so I want you to think about time in the market as being the most effective approach. This is the best strategy, is being in for the long haul. So I want you to think about it like a marathon, not doing a sprint. And then the winners are those that stay in the race. Now, another concept is buying companies that are trading below their intrinsic value. So I was talking a little bit before about, okay, well, what's the value of the company? So this is like finding quality items on sale when you are when you're out shopping, right? You find something really great and you see it on sale, so of course you're going to buy it. So the same thing exists inside of the market. Well, you can find a company that's trading well below their intrinsic value. You buy in at that moment and then you just ride the wave up. But of course, don't forget, there's always going to be volatility. So it's never a sure thing. Now, I think it's really important for us to focus on the fundamentals and the long-term potential when it comes to investing. Now, there's also a strategy that's passive investing, which is investing in index funds. Because these are funds that actually track the market. Rather than trying to beat the market, they're just going along with the market. Now, what's the advantage here? Well, these tend to be lower fees. It's a lot more simple, and it has broad diversification. As we were talking about before, it's really important that you diversify your portfolio. So here, instead of fighting the current, you're just moving along with it, okay? Now, there's some great funds out there, on any of the major fund companies that you can get in on a particular index fund and you put your money in there. Now, my particular approach for all my clients is I don't put them just into one mutual fund or one segregated fund. What I do is actually put them into 4 different ones, because then that way, if one particular fund doesn't do as well as the others, well, then you have the other ones to balance it out. Okay, so my recommendation is, if you're going to do this on your own, don't just put all your money into one fund. Like, I understand that that's already diversified, right? I get that. You have one fund, it's already diversified, but what happens if that particular fund only does 6% in the coming year? Well, then you've only made a 6% rate of return. Yeah, your return is only 6%. So my approach would be, find 4 different funds which are in your risk tolerance, right? And then you put 25% of the money that you have, put 25% into the 4 different funds. Because, for example, where one may only do 6%, another one has the potential of doing 13%. And so then that way, those will average off, right? Now, as I said, this is a lot more simple when you put your money into funds like that. Now, the other strategy is what we call income investing. So this is where you're focusing on investments that actually produce income. Now, you can do this inside of a registered account. So an RRSP, first home savings account. You can do it inside your tax-free savings account. But you got to be really careful with a tax-free savings account, because, for example, there's some people, remember what I was talking about the day trading before? People they try to buy low, sell high, and make money off of that. If you're doing that inside of your tax-free savings account, the CRA is going to notice, and they're going to see that you're trying to make income off of your tax-free savings account. If you're going to do that, if that's the approach you're going to take, then I highly recommend that you get yourself a non-registered account, where now your investment strategy is very clear. You're doing it for income, and then you're going to be applying what I'm going to be talking here in terms of in investing so that you're actually producing income. Now, my recommendation there is that you would then invest in what are called dividend stocks. So, not to overcomplicate it, because I didn't want to get too much into the jargon, but essentially a dividend stock is you purchase a certain amount of a stock, and every quarter or every so often, depending on the stock and what their dividend payment plan is, that they'll actually give you a small portion, and then that money you can either decide to reinvest it or you just take it as income. And so some people take that dividend and they just use it as income. And there's examples out there of people that have particular exchange trade funds that are dividend exchange trade funds that pay out. So for example, one will pay out on a Monday, one will pay out on a Wednesday, one will pay out on a Thursday. And then this way you actually have exchange trade funds that are actually paying you on a regular basis. Now, it may not be that much, but of course you're making money because of that dividend. The other way to do it is bonds, and then of course real estate. So I want you to think about these as that assets that pay you regularly while you're holding on to them. Okay. Now let's talk now about some of the common mistakes to avoid when it comes to investing. Now, I already hinted at one of them. One is the emotional investing. So this is when you're buying when you're super excited, but then as soon as the market starts to dip, you sell because you're in a panic. So I want you to think about this as like letting fear and excitement grab the steering wheel of your car, right? Now, you don't want that. You want to be calm, cool, collected. You want to stay disciplined. So don't let emotions take over the decisions that you're going to be making. This is another good reason why you should have a financial advisor. But of course, you can do all this on your own. But of course, when you have a financial advisor, you can actually have someone to talk to. Luckily, I haven't had to have that experience yet where, someone calls me in a super panic. But it's mainly because I explain very well to my clients the direction we're headed in, what our goals are. We have all of that clear. We know if they're if they're investing for the short term, mid-term, medium term, or long term. And so I tend to go over all of those things with my clients from the very beginning so that they know that they don't need to panic and why they don't need to panic. But of course, inevitably, this does happen to quite a few people, is that they become very emotional when it comes to making decisions. And I just want to warn you, if you're doing this on your own, if you want to be your do-it-yourself investor, do not let emotions get the better of you. Focus on your goal, focus on your plan, and especially if you're in for the long term, just don't touch your investment portfolio, right? Do not become discouraged. Like, for example, right now, I know we're in the middle of a war. Gas prices have skyrocketed. But it would be the wrong decision to make right now to start selling things off because things could be going down right now, but be sure they'll be good to go back up, especially mutual funds, because they're so well diversified. Then they could be just kind of sitting stagnant for right now, but rest assured, with time, there's a tendency for them to go up. Now, the other big mistake, I already mentioned it, but I'm going to cover it again, is trying to time the market. So this is when we're trying to predict the market high and then the low. But when we try to do this, it's extremely difficult. And like I said before, there's people out there that do this, and they're always going to share their good stories with you. They're not going to share the bad stories where they lost a lot of money. So I want you to think of this mistake as it's like trying to catch the exact top of the wave, which is almost impossible to do that consistently. So most successful investors stay invested consistently. Now, the other big common mistake, and again, this is one of the reasons why even in mutual funds, I have investors diversify even across particular mutual funds. Now, and then that is the lack of diversification. So if you're only in one mutual fund, I mean, I get it, it's already diversified, but I want to make sure that you know that you can have more than just one mutual fund. And then, for example, not only that, but you can have one that's low risk, one that's more medium risk, and then another one that's high risk. And so you have everything well balanced in there. You can decide how much money from your portfolio you're going to be putting in each. So for example, the very top one, you can put 20% in the one that's more risky, 50% in the one that's kind of more medium risk, and then 30% at the lower amount, right? So you decide when you sit with your financial advisor on how you actually want to divide the money in your portfolio and where you want to have it invested. But putting too much money into one investment, this is the biggest common mistake that people make. It's a weak point, and it can bring your whole portfolio down from morning till night. And so, or even from night until day kind of situation. Now, the other thing that is a big mistake is ignoring what the fees are. So high fees can reduce your returns significantly over time. So this is something that you want to be really careful of, especially when you're doing mutual funds and segregated funds. Now, the really great thing is that, and then I know I'm using this word segregated fund, and I just wanted to tell you that a segregated fund is essentially a mutual fund, but it's being offered by an insurance company. The great thing about a segregated fund is that it has guarantees that come with it. So I'm going to do, I believe I did like a really short video on segregated funds, like something super quick to explain what they are. You can go search for that on the YouTube channel if you want to know a little bit more about segregated funds. And maybe I'll do another video about that. That's a little bit longer, going into a little bit more detail. But the great thing is that, for example, there are some companies out there that sell segregated funds, and the management expense ratio, this is the fee that they're charging for the management of the fund, is exactly the same as if it were a mutual fund. So I want you to go out there and find, like if you can get a segregated fund that has the same management expense ratio as a mutual fund, plus it has guarantees, that's something that I really want you to take into consideration, because you're getting the best of both worlds. You're getting like a management fee that's it's not that much, not that, like it can range anywhere from like 2.5% to 3.7%. Maybe some of them are outside of that, but that tends to be around the amount. Now, if you can invest in a segregated fund that has guarantees, that has like a death benefit guarantee, as well as your investment guarantee, why wouldn't you do that if you don't have to pay higher than you would for a mutual fund in terms of a management fee? Now, not investing at all is perhaps one of the biggest mistakes. And I want to encourage you, there's a whole series on my YouTube channel where I talk about, I think it's the top 5 reasons why people don't invest. And so if you're really iffy about starting to invest, I highly recommend that you go check out that series out, where I talk about why people don't invest. But of course, one of the biggest mistakes is that, well, I mean, let's go over them. I guess they don't know enough, so they don't want to invest just yet. Another example could be, well, I'm afraid about market volatility, could be another one. But like that, there are several examples of why people don't invest. But not investing, of course, is the biggest mistake of all, because going back to the beginning of the video, we were talking about how if you're just saving that money, now, God forbid, I know this lady, and it must be because she's old school, but she actually still had her cash in a box at home. Now, I'm not trying to make fun of it, because this is the way just people think that come from other economies and other nations, where, for example, in Argentina, when they had the financial crisis back in 2001, well, people had their money in a bank, and of course, the money started devaluing so quickly that there was even that people next day, the money that people had in the bank was half of what they had the day before. And people were going and actually trying to take their money out of the bank. I'm sure that you've heard of examples of this, where economies fail, and then all of a sudden, all that money that you had saved up is worth absolutely nothing. And so I get it, right? Now, reality is that here in Canada, well, let's cross our fingers, it's not very likely to happen that that kind of a scenario is going to happen here in Canada. I don't want to say it will never happen because we don't know what the future holds for us, but the reality is that the Canadian economy is very stable, and well, you're never going to be in a situation where that amount of inflation will occur that will actually reduce your money by half. And so I want to encourage you, if you have money sitting at home, which may not be a lot of us, but if you do, put that money into a bank account and start investing it. Okay, so that because as I was saying at the very beginning of the video, if you don't have your money invested and you just have it saved, well, then the purchasing power of your money is decreasing day by day, year, month by month, and year after year. So please start investing. That's the number one thing. So let's talk a little bit about resources and tools that you can use. And so, of course, now I want you to think about what I'm going to talk about now is that the examples that I'm going to give you, like for example, tax-free savings account and RRSPs, I want you to think about these as containers, okay? Think about these as containers, not the actual investment, because I can't tell you the amount of people that come to me and they say, well, I have a TFSA. So I asked them, okay, well, what's the TFSA invested in? Oh, well, it's in a TFSA. But the TFSA is just the container. It's not what your money is actually invested in. Now, I don't want to blame financial advisors at banks. I'm not here to, criticize. But I think what happens, potentially what could be happening is that when your financial advisor at your bank is walking you through investing your money in a TFSA, they're identifying which mutual fund they're going to put your money in or whatever it is that you want to put your money in. But they're not taking the time to really explain to you, okay, well, your money is invested in such and such a fund, which is now inside of your tax-free savings account. So again, think of the examples that I'm going to give you now as containers, not the actual place where your money is being invested. So here in Canada, we have what is called the tax-free savings account. We also have the registered retirement savings plan. We have first home savings account, which is another place where you can place money. For families that may have a child with a disability, you have the registered disability savings plan. And all these are examples of containers where you can put money and then have it invested. Now, of course, there's also non-registered investment accounts, which I commented a little bit earlier on. Now, this is where you're actually making money off of your investments. Now, you have to remember that unlike the other accounts, so for example, on an RSP, you're putting money in there, but the moment that you start taking money back out, you have to pay taxes on that money. Now remember that at tax time, if you're putting money into your RSP, you're trying to reduce your tax burden. And so that's why people do it. But of course, then you also have a tax-free savings account where that's money that you put in after tax. And so when you pull the money out, you're not being taxed on the money that you take out of the tax-free savings account. And that's why the name is that, tax-free savings account. And then not a lot of people know about these because they're fairly, compared to the RSP, a more recent addition to opportunity here in Canada for people to put away money for either short or medium term goals, right? So I think I lost my trajectory there, but essentially what I wanted to get at is, we were talking about non-registered accounts. So when you start putting your money into a non-registered account, this is where you're actually investing for the purposes of income. Now remember that I gave you the warning. If you're day trading, or and you're trying to do that inside of a TFSA, the CRA could potentially find out, and it could end up taxing you on the amount of monies that you made inside of your tax-free savings account. But that's only if you're using it as a way to make income rather than just a solid, hey, I'm investing my money for the long term. That's what that account is for. Now, if you have a non-registered account, you could be investing in order to actually make money and make a lot of money through it by doing trading, as I said, or whatever you have you. But you have to know that the amount of money that you make in that account is going to be taxed as a capital gain. And now I know I'm getting a little bit into the jargon here, but I just want to warn you that when you start investing in a non-registered account, the amount that you make in the account, so the rate of return that you've made, you're going to have to pay tax on 50% of that at your marginal tax rate. Okay? So it's not that you're being taxed 50% of that money. No, just 50% of the money is being applied that marginal tax rate that you're at. And so that way, you're being taxed on 50% of it. And so whatever your tax rate is, maybe 33% or whatever the case may be. But reality is that that account is specifically for making money as income. So, of course, each one of those has tax advantages, as I just finished explaining. And so you need to think about them as like what you'd use each one of them for a different long-term growth or a medium-term growth or whatever it is that you are trying to accomplish, whatever goal it is that you're trying to save that money for. Anywhere from, buying a new car, putting a down payment for a new car, or putting a down payment for a home, or saving for retirement. So think of, like as I said at the beginning, so think of these accounts that they act like protective containers that help your investment grow more efficiently. So let's get into investment platforms. So you can have an online brokerage, you can have wealth management platforms. And so those would be examples of who you would go to actually invest your money. So for example, a common one that many people ask me about is Wealthsimple, right? Good online brokerage that you can use. And it's some for those do-it-yourselfers out there. Very common. There's a number of them out there. I'd recommend just looking into each one of them. You can also open up an online brokerage account through your bank. I believe all the major banks do. I'm not going to recommend it because I'm not a big fan of the big banks. Check and see if you are at Service Credit Union, if that's an option that you have there. I'm not 100% sure if they have that. I'm not here to push them as a financial institution, although if I had to go with any one of them, I would probably go with Service just because they're not one of the big banks, right? So I want to encourage you to continue seeking out educational resources when it comes to investing. I mean, I'm hitting all like this is a very summarized video that I'm doing to help you kind of grasp the starting points of how you would begin investing. And so I encourage you to start picking up financial books, reading financial books. There's a number of them out there. I'm not going to go into great detail on all those books. Maybe I think that's perfect for a future video. If you want me to make a video on the recommendations I have for financial books, please put a note down below. As if there's interest in that, I'll definitely do it. Then of course there's courses that you can take. And then of course, please get professional advice. A lot of financial advisors like myself, we will sit down with you. The very first meeting is completely free. We give you a little bit of advice. Of course, we're not going to give you everything because there's only so much information that we can give you in the first hour. But for example, when you come and sit down with me, we go through your goals, we go through what your current situation is, and then what I do is I actually put together a financial plan for you. And then at that point, I email you this PDF, which is all my recommendations based on what your goals are, what your current financial standing is, and where you want to be. And I actually put a plan together. Now, whether you decide to go do it on your own or you want my help, completely up to you, right? But it's really important that you sit down with a financial advisor, or a consultant or coach that can give you a little bit of insight into how to move forward. So you can either, and this is the thing, you can either read books, which is going to take you lots and lots of time. You can do a course, which, you could do that in a weekend or perhaps a number of weeks. Or you can go to get professional advice and someone's helping you to actually invest your money. But I want you to think about this as, if you're investing without learning, it's like trying to build a house or a building without a blueprint, okay? So working with a financial advisor can help get you clarity. So clarify your strategy and actually put a plan together. And really importantly, as I was talking about in terms of the mistakes that a lot of people make, is it helps you maintain discipline, right? So it's like having a coach that helps you guide every decision that you're making down the road. Now, quick question, if you and your partner stopped working today, would you actually know how financially secure your family is? Well, most dual income families are earning well, saving something, investing a little, but still aren't completely sure where they stand. That's exactly why I created the Financial Blindspot Scorecard, a simple 3-minute assessment that helps you identify hidden gaps in your financial plan. It gives you clarity on your financial standing, highlights potential blind spots, and helps bring structure and peace of mind to your financial future. If this sounds great to you, get the assessment done. The link is in the show notes below. Again, it takes 3 minutes to get it done. If you're watching this on your TV, scan the QR code. As I said before, click on the link in the description below. Okay, before I get to wrapping up this particular video, I just wanted to show you some concrete examples by using a financial calculator. And so I'm just going to share that with you right now. I'm going to share my screen so that you can actually see the financial calculator. Okay, I'm just going to pull this over to the side here so that I can see it well as well. Now, what I'm about to show you is the amounts that we actually put into the TFSA and for a certain amount of period, and then of course at what rate of return, and then what we will get after a certain amount of time at a particular rate of return. So I often tell people, well, I have another video where I describe putting money away at 200, 400, and then 600. So how about we use those numbers? And I'm going to assume that we're talking about someone who is at 22 years old. We'll start there at 22 years old, and that they're going to be saving for their entire life until they retire early at 60. So that's 38 years of accumulated amounts being put into a RRSP, for example. So I'm just going to switch this to RRSP here. So that's a registered retirement savings plan. So the current amount we're going to put at 0. But as I said, we're going to put in $200 a month. And we're going to do that for 38 years. That's the length. That's the contribution length. And then the accumulation will be the same. So what you see here, well, that's a rate of return that's a little on the high side. The market is paying more around 10%. Now remember, at 10%, this is a little bit more risky. So this would be a growth portfolio. Okay, so if we were to put it in and get a 10% return, that $200 a month. Now remember, this is a long time horizon. So this is a 22-year-old, but putting money away for 38 years, and then this is what the result would be at a 10% rate of return. So that's almost $1 million. It's 920,340. And then of course at 10%. But what I wanted to show you is, what if you were actually able to get a 12% return? Let's look at what the difference would be. So that's that same $200 accumulation and contribution over 38 years at 12%. We would now actually end up at $1.5 million. Okay. And so, like I was saying to you in the video prior, is essentially this is where it can end up costing you thousands of dollars down the road. Now, let's say you didn't know exactly what you were doing, but every year you were putting money away, so you were doing everything right, but you were only getting a 6% return. Well, now imagine at 6%, you only got $336,000. Where at 10%, you would have had above 900, and if you would have gotten 12%, well, you would have been 1.5. This is the amazing, or some would even say the beauty of compounding growth. Now, yes, it all depends on what you're invested in, and I want to just say that compounding growth does not mean just interest. It's actually on the growth of the companies that you're invested in inside of your portfolio. Okay, so that gives you an example of $200 a month at 6, 10, and 12%. Now I want to show you what 400 would be. So if we put now, your contributions would be $400 a month, we'd still be at 38. And so at 6%, you would have 673. Now this would be a very conservative portfolio. Okay, so I wouldn't recommend this for someone who's 22 years old. I would go growth to aggressive growth. And so at growth, if you were to get 10%, now you'd see that same $400 being invested on a monthly basis would now get you to $1.8 million. And if you were to get 12%, well, now you're at 3.1%. So you see the beauty of compounding growth is that once you start getting into like the higher numbers, it's just your money is making money for you, which is what investing is all about, and why anybody can do this. If you just have the discipline of investing $200 a month. Now I get it. We're in very difficult times because of inflation, or the cost of living has gone pretty high. But I am sure that by curbing your spending, try to figure out exactly what your wants are. So if you've watched the video on budgeting, we talked about what your wants are, what your needs are, and then putting money away. And so it's all about controlling your spending and then making the clear decisions on where you want to be putting your money. And so the more that we save throughout our budgeting process, the more we can invest for the future, right? Now, it's going to be different for different people. People are at different stages in their life, I understand. But then if you actually get to the point where you can start putting away $400, like for example, I have a client who's a civil engineer, young professional, very young. She's 26 years old, or pardon me, 24 years old. And she's already started putting away $800 a month. Like, I get it. Her income allows that. She's still living at home, obviously. Things may change in the future, but she's already putting away $800 a month. And so I want to show you now what putting away $600 a month would look like. So at 38%, 38 years at 12%, you'd have $4.6 million. Now you could be asking me and saying to me, Rod, why do I need $4.6 million? I'm a firm believer in that when you are saving and building wealth, you're not just doing this for yourself. It's not for your own pocketbook. It's for the people in your life, the people that you love, the people that you want to help out, the people that, imagine, like, let me put it this way. Imagine being the person in your family that when people are in a difficult situation, or maybe not even a difficult situation, maybe they have a venture, right? They want to start a business, and that you could actually be one of the people that can contribute capital to starting a business, or maybe you want to get in on the business with them. Now you're going to have the capital to do that. You can have the money to actually start a business with someone that you may love, or a close family friend, or whatever the case may be. Now I'm in a position where I'm in 2 joint ventures with somebody. Joint ventures are the way that you can actually even make more money for your family down the road. Now, this is the big difference between not being sure where you are, right, or where you're going to end up, and having complete clarity and control. Now, of course, you may say to yourself, okay, well, I don't need 4.6 million. Okay, well, then give it away. Give it away, right? There's even like, you can have, you can get tax benefits for giving the money away to charity, or giving it away for other reasons, whatever those reasons may be. But the point is that I'm trying to get you to see is that you can get to a point in your life where you don't have to worry about money anymore. And I get it. Money doesn't buy you happiness, but it does make things easier for you. Because if you're in a situation where you're in a lot of debt, life is going to be more stressful. So this is what I want to, especially young people, I want to get them into the habit now of making sure that they don't have to deal with debt down the road, right? I remember from a young age being 14 years old, and one of my first jobs was working at McDonald's as the maintenance service person. My shift would start at 7 o'clock in the morning, and I was there, rain or shine. I would either ride my bike or walk. It took me about half an hour to 40 minutes to walk from my house to the closest McDonald's at that time, which was all the way on 34th Avenue with Parsons Road, if I'm not mistaken. And that's where I worked. I worked at that location of the McDonald's, and I would go but that's where I would spend my summers, is just working there, until I ended up getting a better job working at a chemical plant. Anyways, the point that I'm trying to make here is that the younger you start, the better off you're going to be. And so when you're trying to offset these amounts, let's say you're older, okay? So let's say now you can only save for 10 years. I just want to give you the example so that depending on where you are in your life, you can see where things are at, okay? So for example, let's say you're 50, or let's say you're 55 and you want to retire at 65. Well, you could be putting away $600 a month into an RRSP, or same token, you could be putting it into a tax-free savings account. At that point, I would recommend putting it into a tax-free savings account. And it's going to be the same whether it's tax-free savings account. But the point is that when you start taking the money out, you're not going to be taxed on it. Remember that part. And so if you're putting away $600 a month over 10 years at 12%, you're going to have $134,000. Now, the reality is that 76% of Canadians, when they retire, they have less than $10,000 in the bank. And so what does that do? Well, it requires for them to either live completely off of Canada Pension Plan and old age security, which is not a lot of money. Hopefully you have, I'm going to give you an example. There's a widow in the community who obviously her husband passed away, but wasn't able to finish paying off the house. So now she's left with a mortgage payment. She's trying to figure out how to make ends meet by paying the mortgage, and she's just living on CPP and old age security. I don't want you to be in that circumstance because it's a difficult one. Now, I'm trying my best to be able to help this lady as much as I possibly can, give her some options so that she can learn how to better her situation. Now, this is the case. You either invest money and you have your money make money for you, right? And if you're doing your best to budget and curb your spending as much as you possibly can, well, then at that point, the only other option becomes increasing your income shovel. I'm going to talk a little bit more about that in future videos, but this is something, if you're at the point where you're 55 years old and you plan on retiring at 60 and all you can afford is $600 a month, or let's say even, okay, so that's 134,000, but let's say you even went as high as putting away $800 a month. Let's see what that would look like. And still 12%, then you'd be at 179,000. And so you can see that if you start late in life, you would have to put that much more money away. So in that scenario, not that a lot of people could do it, but if you could put away $1,500 a month, even $1,500 a month over 10 years at 12% would still only get you to 336,000. It's better than not having anything, of course, or even half of that amount. But look at how much your monthly contribution would have to be. So, especially to you people out there, you're married, you have a good job, start thinking about putting away that $400 a month. So let's say, you're not 22 years old anymore. So let's say you're saving over the period of 30 years at 12%. You can still make it to that million. You can still make it to that million, which might be comfortable. And the reason why I do this and I show you these examples is because the clients that I have, they roughly have between $5,000 to $7,000 in expenses on the monthly. So the easiest way to see how much you're going to need for your retirement is, let's say, okay, you have $5,000 in expenses every month. So you can see there on my calculator, I have the 5,000. You multiply that by 12. So that gives you the amount that you're going to need for the entire year. Okay. Now what we do is we times that by 20, because in your retirement, you're going to live about, from 65 to 85. So that's 20 years worth of expenses. So what do you need? You actually need 1.2 million. So if you start saving and you save that money for 30 years, all you need is 400 to get you to that 1.2 million. So that you will have enough to retire at. But that's retiring at 65. Now, the other thing that I want to tell you is that you also, you spend more money in the early years of your retirement than you do in the later years. So you have to make sure that kind of spreads out. And so I want you to have the clarity of mind, or the peace of mind, that you're going to be okay in your retirement. So the earlier that you start, the better off you are going to be, of course. Okay. So I just want to do a quick recap. I'm basing it off of my notes here, of course. So investing allows people to grow wealth, beat inflation, and then reach your goals, whatever they be, short, medium, or long term. And so successful investing requires patience, discipline, and consistency. Never forget that those are the keys. Right? There's no magic wand that you have for this. It's just being patient, disciplined. So that discipline of putting that $400 a month away over that 30-year period so that you can get to that 1.2 million if you're going to get a 12% return, which is pretty aggressive. But remember that the longer you're invested for, the longer time horizon you have, you can, you're going to have that volatility that I was talking about earlier on in the video. But hopefully you can get that 12% return. Finally, I want to encourage you, look, you don't need to be an expert, but what I do recommend is that you make yourself a plan, you set a long-term mindset, and you stay disciplined and you stay invested, right? You don't need to see the entire staircase before you take that first step. You just need to take the first step. And so, as I mentioned, the earlier you started investing, the more powerful compounding becomes, so that you can reach that financial security that you want to build. And the decision starts by making that decision today. You need to make that decision today if you haven't already. If you have, that's great. That's wonderful. I hope that you continue making more money with your money. And, we always, in the financial industry, we talk about, the best time to plant a tree was years ago, but the second best time is today. And I'm going to leave it at that for this video. I want to thank you for taking the time, especially if you've made it to this point, for investing your time in this video. And I want to ask you, please tell me what kind of more videos that you would like me to make. Just drop in the comments below if you have questions, if you want me to tackle other issues, you want me to go more deeply into investing, whatever the case may be. I'm going to do my very best to continue doing long form videos and educating as much as I possibly can, because in my heart of hearts, that's what I'm dedicated to. I've always been someone dedicated to helping people in the community. That's my passion. And so whether you're doing it on your own or you need help with a financial advisor, these videos are here for you. You decide what you want to do with the information. If you want my help, I'm also here for you. And I want to ask you, please don't forget to subscribe to the channel so that you can be notified when new videos are going up. I'm trying to do, again, I said this in the last video, do or do not do, right? So I'm going to do one a week and get them up on Mondays. If not, then Tuesdays, but get them up at the beginning of the week. And I'm going to be doing one a week for as long as I possibly can, so that I can pass on as much education as I possibly can. Again, don't forget to subscribe to the channel. And then I'm also going to put links down below to tools. There's a budgeting tool that I had in my last video, and then also a scorecard that I do. It helps you identify what your financial blind spots are. And then, of course, there's a couple of ebooks that I've written, and I'm going to put links to all that down below. Check it out. Let me know if it's of any benefit to you. And again, if you want me to address more issues, let me know. I'm asking you what you would like to know, and then I'll put more time into addressing those particular questions as best as I can. Thank you so much for joining me on this video and for sticking around till the very end. All the best to you and your family.